All right, welcome folks. First of all, huge thank you to Owen for having me here. This is an absolute pleasure to be here. The quality of the presentations, the speeches so far have been absolutely amazing. So this is a very high standard to live up to. So I'll do my very best to keep the standard as high as possible. So in this session, I'm going to focus more around crypto and try and deliver some angles that maybe might be a little bit different to what we've kind of covered already, just from a different kind of lens. And so we're going to look at the crypto market and how we can leverage information to trade better in the crypto market. So we're going to look at what actually moves the crypto market, because there's not really much point jumping into talking about liquidity pools, especially the riskier ones that I trade and get into, if you don't understand the crypto cycle or what moves the crypto market. This is also going to help you if you have any crypto investments, so that'll be very beneficial. Then I'm going to talk a little bit about the DeFi opportunity that's currently on the table. We're going to look at how liquidity pools work, so bear with me on this one. It might get a little bit technical, but I'll do my best at kind of flying through it and not making it too boring. Then I'm going to look at some of the risks, because there are risks with liquidity pools. We're going to look at some case studies. I'm going to look at some results that I've gotten myself with some of my own private members. And then I'm going to tie it all together at the end with whether you think we should be buying or selling crypto right now, because that might be on your mind. And especially if we're talking about liquidity pools, it's really important to discuss that at the end. And then at the end, if you have any questions, feel free to write them down as you go. Maybe we'll take them all at the end, just to keep the flow going. So yeah, so this is my story. My story is, I think it's a little bit different maybe in some areas, in terms of I kind of took the traditional route with my career. What's the traditional route? Well, you go to college, you get a degree, and you go get a job, and that's it. And so I kind of followed that path and ended up working 12 years in tech. So I worked for LinkedIn for 10 years, managed a team there. And then previous to that, I worked 3 years at Google. So my entrepreneurial journey started quite late, because I kind of focused on the traditional route, you could say. But you know, I mean, it was a great journey. I learned a lot. But something kind of clicked in me along that journey, because on paper, you know, I had the great job and the good package. You know, I was on a decent 6-figure salary, but the money just wasn't adding up. And I think when I got into watches, that really kind of opened my brain, because there's a store in Dublin called Weir's, and I never really had a huge interest in watches, but I walked past one of the windows, started looking at the watches, and I'm seeing these 40, 50 grand watches. I'm like, who's buying these watches? Because, you know, I'm on the good salary. They're buying the watches. You know, I'm on the good salary here, the 6-figure salary in the tech companies, and they're so out of reach for me on the salary I'm on after taxes. And as the guys covered earlier, Dublin's and Ireland's a very expensive place to live, very, very high tax. So there's something was missing in my loop. I was like, no. It literally hit me like a ton of bricks, staring at the watches, being like, I'm missing something here. There's a click here that's not adding up. And that was just after the pandemic as well. So I saw a lot of people get chopped right in front of my face, like managers, very, very senior people, sales people that have been there for 6-7 years, that built some of the products at LinkedIn, all gone, whoosh, chopped. And so my mindset started to like completely flip. And I figured out that, well, first of all, I'm not making enough money. And second of all, that I had to have some sort of product, some sort of skill that I could survive myself. So not have to rely on, you know, other people per se, but that I have a skill that I can use, that I can leverage in multiple different ways to make money. And so that's when I really started pivoting back into crypto, because originally I got into crypto in 2018, bought XRP, got absolutely smashed on it. So I had a really bad taste in my mouth for about 2 years, but I got really, really back in 2020. And that's when all these pieces started to fit together. So from there, again, it's a different perspective, but I wouldn't say that like I had a really, really difficult upbringing. You know, I went to the college, got the degree, all that kind of stuff, you know, worked normal jobs. But for me, I figured out that I had to leave the really comfortable job, which is it's a different flip. Because when you work in tech companies, you get looked after, you get very, very good money, you get stocks, everything's free, your food is free, your insurance is free, like your laptop is free. You know, there's an office full of very, very beautiful women and men. So there's a lot of benefits to these jobs, and so to walk away from that in my head was a big challenge, but I decided that I wanted to go down the entrepreneurial route and start to help people, educate people, teach them about Bitcoin and crypto, because I saw it as kind of a niche, a gap in the market for proper education in terms of onboarding people from zero to hero in crypto. So that's pretty much what I do. So over the last few years, I've pretty much built my own online 6-figure online education business, which teaches people, again, it's not super focused on day trading, scalping per se. It's more on onboarding high net worth people into the crypto space that otherwise wouldn't be able to get onboarded because they don't know how to use crypto wallets and all the complications that come with cryptocurrency. So I focused around that niche and just scaled that organically, just posting content. As you can see, I've posted over 1,123 pieces of content and scaled my brand organically. I've never used paid ads. I've never even done sales calls. I've literally done everything through DM and building trust, because when you trust, what I've learned, having had no sales experience, you will get clients and you can sell relatively easy, I guess, given I haven't done sales calls, for example, which I'm going to start doing now. On a side note then as well, I've also have 17 years of experience of playing music. So I like rock music. I've written and recorded my own albums, engineered, produced my own albums. And I've had specific goals at each one of these levels, and I'm getting there slowly but surely. But one big standout for me was with my music career. My music career was a side hustle, I guess, but for me it was a career. I wasn't making any money, but I ended up playing on one of the most prestigious venues in Ireland, which is called the Olympia Theatre. That was always the goal I wanted to get to, and I got that goal. So that was huge for me. But one thing I just want to say before I move into the actual kind of the hows and the crypto stuff is, if you're starting off on your online kind of business, it's going to be mentally tough if you're kind of changing and making content. So just be aware of that you have to have a kind of a bulletproof mindset in terms of, especially if you're going to put your face out there. I know some of you guys are brand new to content, but for me, what worked really, really well, and I really, really can't overemphasize this without it sounding like really cheesy, but genuinely visualizing exactly, like in extreme detail, of what you want to be, or what it looks like for you, what success is to you. For example, when I got that gig in the Olympia, I just made my mind up that was going to happen, and I stuck the Olympia Theatre, the view from the stage out. I stuck that, and then I stuck the view from the stage down in my wardrobe and over my bed. So every single night I would see them, and it was programmed in my mind. And I got to the point where I had no idea how the hell I was going to get this gig. I had no idea. I knew I was going to do it. It was going to happen to me. And so I visualized like every single day walking down, like what I was going to say to the crowd, like how it was going to feel, what I was going to wear, like literally every single detail, like every single detail. And when I actually got the gig, it's a very intimidating stage because it's really, really high and the audience are really, really close. And I kind of was warned of that, it's intimidating. But when I walked out there, because I visualized it so many times, I felt like it's going to sound cheesy, but it's exactly where I was supposed to be. I felt really, really confident. Everything I was going to say was completely like planned, but not in a planned way. It was just because I'd gone through it so many times. And so when you're building your businesses, I think you have to visualize what that success looks like. I also replicated the exact same model. I took it from the Olympia when I got my job at Google as well, my first job. I used to walk up and down the street in Google like once a week. My mentor at the time told me, just go do that, visualize yourself, and that came through as well. And I always wanted to stay in the Burj Khalifa, and I knew it was going to happen someday. And then, Owen just messaged me in the summer being like, hey, I actually saw the list go out and I wasn't on the list. I was like, oh, damn, I'm not on the list, I was with my missus in Malta, and boom, text comes in. Oh, Owen, yeah, we're gonna. Do you want to come to the event? And boom, here I am. So visualizing is so important, because if you can't visualize it, how are you going to get there? You have to visualize the end goal, and the path will appear. So I'm the definition of that. That definitely works. So that's just a little background of myself. But yeah, before we jump in, I'm just curious, like who actually invests in crypto? I know some of you get paid in crypto. Okay, so we've got a good few people in crypto. Who doesn't invest in crypto or has never bought cryptocurrency? Okay, cool. Just you? Okay, two. Okay. Well, kind of like what Dolby.
Get out of this room.
So kind of what Dovey said, like this, some of this stuff might be very basic, but I want to make sure everyone understands. So just let's go through it together. But does anyone have any idea what actually moves the crypto market?
Jason.
Jason's wallet. Does anybody any hands, any clues for what actually makes the price go up and down, or what moves the markets? Well,
supply and demand.
Yes, for sure, that's one thing. But there's a few specific things that move the crypto market, which basically moves the stock market, because as much as Bitcoin wants to be a hedge against inflation, which it is long term, it tracks the Nasdaq, it tracks the S&P 500. So we need to have a good grasp on how the 4-year business cycle works. And so every 4 years, basically, the crypto market goes up and goes down, but it follows the stock market. And so there's a few factors that lead to that. The first is the 4-year business cycle, where naturally the business cycle expands and contracts every 4 years. And that is because of the 4-year liquidity cycle, which is basically how the Fed, the US government, control how much money is in circulating supply in the world, basically because the dollar is the reserve currency of the world. The 4-year presidential election cycle, because every 4 years in the US, who basically control the financial system, that person changes, and so with that person changing, monetary policy changes. And then at the bottom of the list, which a lot of Bitcoin people and crypto people will say is the 4-year Bitcoin cycle, which to me is the lowest out of these in terms of priority. The 4-year Bitcoin cycle basically means every 4 years, the amount of Bitcoin that enters circulating supply gets chopped in half. All right, so Satoshi Nakamoto, who invented Bitcoin, he pretty much was a genius. He programmed all this stuff into the actual code of Bitcoin itself, which is ingenious in itself. I mean, it's you get a trifecta, effect of all of these things moving together. So this 4-year cycle, this goes back to the 50s. This is not something that's just like in the last few years. We've generally seen ups and downs in the market, not perfectly as you can see, but generally speaking, every 4 years. Sometimes it extends to like a 6-year cycle, a 7-year cycle. But generally speaking, every 4 years we've had ups and downs. And sometimes even every 4 years we get a recession. So that's just something to take into account. But you can see even just the big drawdowns in the S&P 500, which is a basket of the top stocks in the world, that tends to go up and down every 4 years. And Bitcoin tracks the Nasdaq, which basically tracks the S&P 500, because crypto acts as a risk asset. It's not treated like gold, like a hedge against inflation, in terms of if there's a big war or something like that, Bitcoin crashes because it tracks stocks. It trades like a risk asset. So why does it move? Why does the price go up and down? So someone have a question? Another wallet? But if you can kind of grasp what we've talked about here, you will be able to understand exactly when crypto is going to go up and down and when the best buying opportunities are. But why it moves up and down are interest rates. So how cheap is money to borrow? So if money's cheap, that means companies like the Morton's companies can expand, hire people, get more people have money to spend, and so that money can come into the economy, can come into the stock market, and then trickle down into the higher risk assets such as crypto. The Fed balance sheet, which is basically the Fed in the US, their like wallet, like how much money they have in circulating supply. So they control whether there's money being added or taken out of the economy by levers they have to pull, and then unemployment rates. So these three factors are huge things you need to be aware of in terms of trying to anticipate where the price may go. And this may look a little bit confusing, but this is just a visual representation of some of those data points. So the green line is unemployment. You can see when that line shot up during COVID, interest rates, the blue line went straight down. Again, the government, they're just pulling levers to try and accommodate the way the economy moves and when bad news happens, for example. But you can see that lever went up, unemployment went up, the interest rates lever went down, and then the orange lever, which is the balance sheet, they just printed a crazy amount of money, like an insane amount of money. I think the stat is not 100%, but it's half of the amount of money ever was printed between 2020 up to where we're at now. So in the opposite direction, when interest rates start to go up, you see, and the balance sheet contracts, or when they start to tighten the balance sheet, that's when the risk assets start to drop. Now, it doesn't always happen straight away. That's why you have to sell the news, because a lot of the time the market moves in anticipation or as a forward-looking indicator to what might come. So hedge funds, obviously, they're going to be smart. They have to be smart. They have to be quick. They can't wait for the event. They have to get out before. They need to use us, retail, as exit liquidity. So as of right now, a lot of people are wondering, why is my altcoin not moving? Why is altcoins not going up? Well, as you can see, this chart is the total tree, which is the total market cap of cryptocurrency, excluding Bitcoin and Ethereum, minus USDT, because stablecoins are a huge part of the crypto market cap, divided by Bitcoin. So basically this chart is showing, with the same indicators, but it's showing the strength of altcoins to Bitcoin. And you can just see, literally since the top of 2022, altcoins have just bled. So this was even a learning curve for me about when is the best time to actually rotate your Bitcoin if you're going to do it into higher risk plays. And really, for the best part, unless you were trading in and out and swing trading in and out using my trading strategy, you pretty much would have bled to Bitcoin for the entire of the last, 2-3 years. The good news is though, if you do hold altcoins, for example, now you can see that the balance sheet, the Fed have kind of hinted at quantitative easing, which basically means they're going to print loads of money, and that line is going to go back up. And so I think the markets are they're anticipating another rate cut, which is going to be, I think, tomorrow, 29th. And then if the Fed had to expand their balance sheet, these will be two kind of triggers to push the market up, hopefully into a top at the end of the year. Now, I think the rate cuts are probably priced in at this moment. I think we're waiting for that liquidity to come back in, but you can really see, obviously it's extreme during COVID when the money printing was just absolutely ridiculous and they screwed over pretty much everybody on the planet by causing crazy inflation and making everything insanely expensive. But you can see the effect on altcoins specifically. They love money, they love liquidity. So we need to track these pieces of data to understand when are the good times to get in and when are the good times to get out. And this is how I was able to track the bottom of the Bitcoin market. Okay, I didn't get a 15K entry, but my average entry was around 19.5K, which is not the very bottom, but it's pretty close to the bottom. 600% move up to the top. But you can track it not by listening to YouTube channels or not by reading a million different X posts. You have to understand it yourself, and my approach to trading and stuff is just common sense. A lot of this stuff is common sense. People are losing their jobs, they're not going to have money. If money's too expensive, they're not going to spend it on risk assets. It's literally common sense, most of this stuff. And to be honest, that's kind of one of the reasons I wanted to get into crypto. I found the barrier to entry was kind of low because some of the information is just so incorrect and not good. It's just really, really bad. So we know every 4 years the crypto market goes up and down. We know that because of the 4 different things that move the market. We know that this has been on since the 50s, and so we know that Bitcoin tracks the NASDAQ, tracks the S&P. So is this useful information we can actually use to trade or invest? Because we've talked a lot about making money and everyone seems to be doing pretty well at that. We're trying to all scale that, me included. But it's also good to know when's the best time to actually potentially get into the market for long-term wealth. And Owen made a really good point earlier about that. I think that was your number one learning curve, was not to go out and buy all the cars and put it into assets. And so if you can understand this and conquer this, you can really, really do well on your investments. So is this predictable? Well, let's have a look, right? So the first cycle, which is given a pretty premature cycle, this is the 4th year of the Bitcoin 4-year cycle in the last quarter. So what happens in the 4th year, in the last quarter, which is exactly where we are right now, in that kind of 4-year liquidity business Bitcoin cycle? What tends to happen? Well, let's have a look at 2013. We rallied up July, August, pull back into September, and then a final rally top in Q4, which is like somewhere between November and December of this year. Second rally up July and August, pull back into September, top in Q4. Third time lucky. Rally up July and August, pull back into September, and a top in Q4. That's weird, no? 3 times in a row. So what about now? Rally up July, August, we pulled back into September. Okay, we're on that potentially on that phase up to the last rally in the cycle. So we're at around 115K Bitcoin the last time I checked. So we can use this information. This is predictable stuff because we know what to track and we know what data points to track. And it's cyclical. You can make a lot of money investing in cryptocurrency, especially even if you're just trading spot over a 24-month to a 36-month period, timing these swings, which is kind of the way I trade. You can compound spot positions with no leverage very, very, very quickly. and quite, I wouldn't say easily, but technically to do it, it's not that difficult. It's a lot of it is psychology. So
is there an average percent does when it does that pull back and then the rip?
It pulls back usually like 60 to, well, it's 75 to 80%.
But when it does the rip, is there an average
to the upside?
Yeah.
Not really, because there's like law of diminishing returns. So each cycle is usually less. Like the last cycle, I think was like a 9x to the top. Right now we're at like a 6x. Okay. So because the market cap gets bigger, the law of diminishing returns on the upside is kind of capped. So that leads us to like the opportunities. What opportunities can we use? Because we now know that there's a 4-year cycle, so really we just need to be aware of where we are in that cycle if you're going to get into any kind of risky crypto investment or project. But the opportunity really came, I mean, Trump getting into office changed a lot of things for cryptocurrency. It cemented a lot of the problems that we were having into law and actually backed them, such things as the Genius Act. So because of Trump getting in, I mean, the opportunity has kind of opened the doors again. You've seen a lot of companies go public. Coinbase went public. Well, they went public before actually, but Circle went public. And we're probably going to see more. Kraken are doing an IPO as well. But you're starting to see now the US, these companies come back to the US because they're not afraid of getting sued. For the last 6 years, basically, every crypto company was getting sued. And so the opportunities were quite small because founders were terrified to move to the US because the Biden administration were literally crushing them with cases. So that leads on to the opportunity with DeFi, right? So I know most of you are very familiar with this, but there's a few main components of DeFi. Stablecoins is one. I know a lot of you get paid in stablecoins, but in case you didn't know, I mean, a stablecoin is just a one-to-one backed dollar that's on the blockchain. So technically for every one USDT or USDC, they should be backed by $1. They're backed by the US dollar and treasury bonds. There's two main like flavors of stablecoin. We have Tether and Circle. And yeah, so these components then make up DeFi. So what is DeFi? Well, DeFi is basically the financial rails built on blockchain. So it's basically replacing people with code or smart contracts. And with DeFi, you can, I mean, the lads have their own company, we'll talk about it, but you can lend, you can borrow, you can earn interest, you can trade. But the big game changer is that you are now removing middlemen or middlewomen out of the system and you're replacing it with smart contract protocols. So, I mean, even to me, it's just kind of funny when you think about it, that if I want to send like Owen 10 grand or 20 grand, I need to get permission, you know? And it's going to take a day or two and might get blocked. And, you know, it's kind of mental when you think about it that way. Like, how are we still using this? This stuff was built in the 70s, 80s, and 90s. Like, the technology is so old, it's actually insane. But blockchain is fixing that. And now you can send instant settlement at the speed of an email, which is, if you think about it, again, common sense, it's the future, right? It's how are we going to use these data systems? And we're seeing that right now. Even last week, there was a huge big conference with the Fed, where literally the top founders of many of the top blockchain companies met with the Fed, and they're like, okay, we're going to move you onto the block. We're going to move the financial system completely onto the blockchain over the next 2 to 5 years. And that's happening right now. Everything's working. The main problem with DeFi right now is that because the banking system is so old that there's certain accounting protocols that they just can't bring into the DeFi space. They haven't figured it out yet. So there's a 2 to 5 year plan to figure that out, iron all that out. But in the next 5 years, everything is going to probably move across to the blockchain in terms of the financial system, which gives us a huge benefit and head start in DeFi and opportunity. And again, we'll talk about some of the companies the lads have. So what is a liquidity pool? Well, a liquidity pool is a pool where cryptos lock up smart contracts, or lock up their crypto, in smart contracts. So basically, they're pools that allow traders to trade in and out of. And by doing that, by putting your money into, or your crypto into a liquidity pool, you can then earn fees or rewards. Pretty straightforward. So a lot of confusion sometimes around liquidity pools is, okay, if I take, when you go into a liquidity pool, this is where it gets a little bit technical, you have to usually pair your assets, right, in a volatile pool. There's a volatile liquidity pools and there's stable liquidity pools. But I like to go into volatile pools because I like to take a little bit higher risk. But when you go into a pool, you have to lock up 2 tokens as a pair and put them into the pool. And so, okay, what happens to my tokens when they're in the pool? Is it like the banking system, the fractional reserve banking system, where like I deposit my money to the bank, and then my money goes to, you know, Emma there, and she goes buys a house with it. So it's not actually in the bank; it's out in other people's pockets, and so it's not actually there. If you had like a run on the bank, the money's not in the bank, you know. So it's a flawed system. Well, liquidity pools aren't like that. The tokens stay in the pool, and they're just being swapped in the pool, and then you are earning rewards, mostly trading fees. But with some pools, if you get early access, you can get extra rewards, i.e. the token of that pool, which is nice because that can compound. But this is just a general kind of breakdown of how the liquidity pools work. So why is this important? Well, I think we kind of hit on it, but we want to have control. You want to be able to get in and out. Like if the lads wanted to send me money in the weekend and they had it in a pool, they can take it in. They can take it out, at their own, whenever they want, because with the current situation, you have to ask for permission, it takes time, and so this has a very good market fit. The other aspect for liquidity pools, why they exist, is that crypto itself is not a very liquid industry if you look at it compared to like Forex or gold, where the market caps are much higher, trading volume is much higher, and so in crypto it's a problem. There's not a lot of liquidity. So what does that mean? Well, that means if like a whale wants to come in and buy X amount of a certain token and he wants to get a big order, the problem that this is solving is that there's not enough sellers to meet the demand of the buyers. There's not enough liquidity, there's not enough depth in the book. And so when you're locking up your cryptos into these pools, you're helping by adding liquidity, which enables these deeper order books, which enables cheaper fees, faster fees, and bigger orders, which is what every blockchain, whether it's Avalanche, Ethereum, Sui, Solana, any of these chains, they want liquidity. They want the chain to attract big whales, big traders to be able to trade on them. So one of the best pieces of advice I was given in the last crypto bull run was, and I got asked like, what do you think of this coin? What do you think of this coin? Is to just pick a handful of cryptocurrencies and have a good grasp of those. So 2, 3 max. So my main cryptos that I like to stay involved with in the communities and what's going on is obviously Bitcoin is one, Avalanche, and Sui. So the DEX, one of the DEXs we're going to speak about is on Avalanche, and then the guy's DEX is on, or LP is on Solana, which is another fantastic one, which is second to Ethereum in stablecoin market cap, which we'll talk about in a second. But Avalanche as well, this is just one of the cryptos that I like to follow for the gaming and what's going on with the real world assets or tokenization of assets, putting them on the blockchain. Avalanche is one of the top cryptos leading in that space. Here's some of the companies that are building on Avalanche. And so when you're in the Avalanche ecosystem, you're in the Twitter feeds, you're in the chats, you pick up information, you get head starts on things that are happening on that chain. So why did I kind of pick Avalanche? Well, as one of my cryptos to kind of lock in on, is really based around Ethereum, and it's EVM compatible. So what that simply means is that the brain, the smart contract engine, the engine of Ethereum is compatible with Avalanche, or Avalanche is compatible with Ethereum because Ethereum is around first, which basically means, in simple terms, that liquidity can easily flow between these two blockchains at a cheaper price, easier bridges, with less fees. And that's what institutions want. They don't want to pay a fortune. They want to be able to access liquidity that's on the number one chain. And Ethereum has the highest TVL. This is really important. It has a $87 billion locked in the chain. And TVL, or the total value locked, that just shows you how much trust is actually in that chain. Like how much money are people locking up in the chain. And so it's a good measure of trust, basically. So, okay, so Ethereum is at that level. The market cap of stablecoins, you can see, is at 157 billion, right? That's a very important number as well. So why do we care about that? Well, its closest competitor, number 2, which is Solana, you can see the market cap stablecoin of Solana is way smaller than that, 13 billion, all right? So, and the TVL is way smaller, 7x smaller nearly. So given the fact that Ethereum and Avalanche are like brother and sister, you could say, or whatever, and you can easily merge between the two chains, and because of some of the protocols of how Avalanche works, the main one is you can customize Avalanche in a different way that you can't do on Ethereum because of the coding, which enables privacy. And so that's why you're seeing JP Morgan, PayPal building on this chain, because they can hide, they can make their blockchains private, because they obviously they don't want us to all track the wallets and be like, yeah, we can see this guy's like 10 million. You know, that needs to be private. So for me, Avalanche was just one of those interesting ones. There's a hell of a lot of room to grow on Avalanche. The same for Solana. They both have a long way to go if they're to catch up with Ethereum. So both of these cryptocurrencies are, in my opinion, great cryptocurrencies. Not financial advice. But you can just see, I mean, look at the stablecoin market cap, 1.6 billion. I mean, even if we got a small percentage of a flow into either of these two blockchains, there's so much headroom that can flow into other projects on the chain, such as Solstice, the guy's chain, which we'll talk about. So that's really important. You want to go where the money already is. You don't want to try and rewrite the book. Again, common sense, try and keeping things as simple as possible. So one of the DEXs I like to play around in is Black Hole, which is a brand new DEX and Liquidity Pool, or LP, on AVAX. And then the other one, of course, is the guy's products called Solstice. We'll talk a little bit about the product side of the house towards the end and how maybe you guys can monetize it, and maybe we'll have Owen kind of chime in there a little bit. But right, so that's kind of the basics of how the pools work and the higher level stuff. Now I'm going to jump in a little bit in depth on how the riskier side of the house works for liquidity pools. So as I mentioned on the Avalanche example, you can go into pools in two main ways. You can either go in with two stable coins, which is the product that the Mortons have, or you can pick two non-stable coins, a volatile pool. And so the risk to reward, obviously, is much higher when you're holding two volatile tokens. All right, so for any pool, usually you go in with the two cryptocurrency pairs. So when you're picking your pool, you want to make sure that if you're going in with two tokens, you're locking them up, that you understand you have a good grasp of the fundamentals of those cryptos, because you're going to hold them, right? So you don't want them to disappear overnight. So for example, let's say you have 10K. You want to go 5K and 5K into each token, because when you go into a volatile pool, you usually have to have 50% equilibrium of both tokens. So you have to hold both tokens to keep it balanced, because the pool always needs to stay balanced in the volatile pools. We'll talk about this in a second in the risks. But just for now, that's all we need to know. So let's say you have the two wallets, you've picked the two cryptos, you've picked the two tokens, you're like, okay, now I need to go find a pool. I've given you all the pool, but there's pools on every blockchain. There's pools on Avalanche, there's pools on Ethereum, Solana, Near, any of the top layer ones, Hyperliquid, there's loads of them. You find a good pool, then you lock up your tokens, but in this case, the pool I'm talking about, they're not actually locked. You can just deposit them, you can take them in and out whenever you want. You deposit your tokens into the pool, and then you start earning trading fees, but in some of the pools you get an extra incentive. You get actually the token back of that DEX or pool as well. Now with these rewards where you get the crypto token as well, they don't tend to last forever. They're only like in the initial launch phase to incentivize people to come into the chain. So think of like Radium, think of Aerodrome on Base, which we'll discuss and just cover later. So you are now being paid. Like let's say you were going to hold these two tokens anyway, or you're going to hold Bitcoin and Avalanche anyway, regardless. You can get paid to hold those tokens. You're taking a little bit of risk, but if you don't care about the price going up and down, you're going to hold it for 2 years anyway. It's fantastic in a bear market, because now you're going to hold them anyway. So why not hold them? Okay, take a little bit of risk, a bit of percentage of how much you're comfortable in your portfolio, but get paid. Get paid to hold the tokens. And then if you get paid, if you can get pools that give you the native token of that pool, and let's say you've got at the end of the year, I don't know, 10K worth of this token, and this token goes on and does a 10x, now you're compounding the hell out of that money. So not only are you getting paid to hold the token, let's say these tokens do well as well, that token goes up, the token you're earning goes up, and you've compounded your wealth like crazy. Now, obviously there's a little bit of luck and timing involved in this, but it's been done. So anyway, you're earning your rewards, then your liquidity is still locked up, your rewards go back to your wallet. Again, you have to manually click and claim these rewards, whether it's daily, weekly, monthly, whenever you want to do it. And then you're like, okay, cool, I'll leave the tokens locked up, but I want to cash these bad boys out. So you can then swap these out to USDC, get your USDC back to your wallet. And maybe at that point then, they've been in there for a few months, and you're like, right, I want to take my tokens back out. I'm done with this. They've maybe gone up 2x. Then you withdraw. Again, there's no lock period on the pools I get into, so you can withdraw your tokens back out. And then at that point then, do you want to cash them out? And then you buy Owen's Lambo. All right, so that's the gravy train side of the house. So what are the risks? Are there risks, Steve? Yes, of course there's risks. No such thing as a free lunch. These guys are one of the biggest risks. Has anyone heard of the Lazarus Group? Yeah, there was a hacked Bybit for 1.4 billion or whatever it was ETH during the summer. I mean, they've hacked banks, they've hacked airports, they've hacked the best exchanges. I mean, Bybit's the top 3 in Dubai. I mean, they hacked them, and the way they hacked them is scary. I mean, they infiltrated the signing of a wallet, which is, I mean, how they did that is just crazy, but they did. So hackers are a big one. The other big risk is something that you will definitely experience. If you're in a volatile pool, you will definitely experience this. I'm in drawdown on some of my positions, but I'm going to explain it right now because it's part of the game. So we've discussed that we need to go into a pool, in a volatile pool, even a stable pool, with 2 tokens. So whether you're pairing 2 stable coins together or 2 volatile tokens together, you need to split, for volatile tokens anyway, you need to hold 50% of each token. So let's say you have 10K, you're like, yeah, no worries, I'm going to pick token A, I'm going to pick token B, 5 and 5. Let's say Bitcoin drops, and we're chatting to Owen about this, we're in a few pools, and it's like, look, if Bitcoin drops to 107, these tokens are going to drop too, right? So Bitcoin dropped exactly to 107, to the wick. Intervals of $500, by the way, on Bitcoin are extremely strong buy zones and sell zones. So like 17,000, it was 107,500, I think we wicked right down to and wicked back up, which is exactly where I had the alert in the chart. But let's say token B drops, okay, so it drops 60%. You're in the pool now at this point. You've invested 10K, but the Bitcoin, or the stock market crashes, Nasdaq crashes, Bitcoin crashes, altcoin crash. That's literally the flow of order here. And then your token B drops 60%. So now your 5K has dropped down to 2,000. So what's going to happen here? Let's say the token A is not a stable coin, so that would have dropped a little bit as well, let's say, for argument's sake. But what's going to happen here now is the pool needs to stay at equilibrium. It needs to stay 50-50. So what's going to happen is token A is going to start to sell off and try and buy back up token B because they need to remain at 50%. So token A is going to start to sell off and try and buy back up token B. So for example, in this case, instead of being down 60% in a good situation maybe, you're now down 36% because it's trying to balance it out. As this price is falling, this is going to sell off to try and bring it back up. Now, if both of them are falling, unfortunately, they both sell off into each other on the way down as both tokens fall. So impermanent loss is part of the game unless you're going to do a much less riskier strategy, which is what the guys have, which is stable coins. You're going to pair stable coins to stable coins. But again, I don't know, I like more risk. So now in this case, you know, your 10K investment into the pool, you're still earning the rewards, by the way. And again, that token might have dropped as well, because if you're getting rewarded in that native token, that's going to get hit by the market volatility as well. But in this case, your 10K is down to like maybe 6.3K. But again, you were going to maybe hold these tokens anyway. So, you know, you're up for that ride before you signed up for it, you know. So that's the biggest risk you're definitely going to experience once you get into these pools. So you need to time your exits and your entrances correct. That's why I spend so much time at the start explaining the cycles and explaining where we're at in those cycles, because you need to have a point of reference for where we're at in that business cycle before you go into these types of riskier investments. So impermanent gain, I won't spend too much time on this. It's the same, it's just the opposite. So let's say token A goes up 200%, and you're like, oh nice, my 10K has gone to 20K. Well, no, it's going to sell off and bring them back to equilibrium again. So if one token outperforms the other token, it's going to sell off. So you would have actually been better to just hold token A in this situation. But remember, you are compounding and earning trading fees. You're earning the native token of that blockchain. So that has now gone up as well. So you do outperform holding just the token because you're getting compounded on the side. Yes, you're capped a little bit here on the upside, but nothing too crazy. In this situation, then you might think, okay, my 10's gone to 20K. Well, no, it's because of the impermanent gain. It's dropped back down, and so maybe your 10's gone to 17.3K. But you can see if you get into these pools, like in a bear market, I mean that's where the crazy money is. Because can you imagine getting into? I'll show you some examples now. But let's say you go into a bear market, everything's boring. You get into a pool, and then the pool, you know, the bear market kicks or the bull market kicks in. The pool starts to go up. The two tokens in the pool. So it's really important to pair good tokens. Those tokens go up, the token you were kind of earning or farming on the side, that goes up. Everything compounds like crazy. It's crazy. Right, so let's look at some case studies here. So does this work? Like, has this worked before? Like, why have we been talking about this? Is there any proof of this? Well, let's have a look at Aerodrome. So Aerodrome is Coinbase's, Base Chain is Coinbase's, it's basically a fork of Ethereum. It's their version of Ethereum. And Aerodrome was the top chain, is the top DEX LP on that chain. So with these tokens, when you launch, as I mentioned, like the incentive's high at the start. So at the start, there's a lot of farming of the tokens. And so that creates a lot of sell pressure. So on these launches, initially, a lot of the tokens dropped 70 to 80 to 90%. Okay, so Aerodrome dropped 70% on launch, and then went on to do 124x, not once, but twice. So if you messed up the first run up, I mean, if you didn't sell the second run up, you deserve a smack. I mean, that's crazy ROI. But what you'll notice is the bottom left here, the tokens tend not to do much for around 12 months because there's so much inflation and there's so much sell pressure because of weekends, whatever you want to say. But people are just cashing out. So there is that kind of like delayed impact for the price action to actually manifest in the token. Radium, the top one of the top DEXs on Solana, the exact same story, launched down 95%, went sideways. These are weekly candles, by the way. Sideways for a year, almost to the date, and then did a 53x from the bottom. So if you get into these plays, I mean, could you imagine you're in two solid cryptos, but maybe they do a 3 or 4x, and then the token you're earning that's compounding does a 53x? I mean, the money is insane. And you do nothing. You don't have to do anything. You can trade in and out of the pools. If you find a good pool, you can just leave it, set and forget it. Now, they're hard to find because sometimes you can go out of range of earning. It's a little bit complicated, but I won't get into that. But there are pools you can find in simple terms. There are pools you can find where it's set and forget. So this is the token that we're at right now. Exact same situation, dropped 90% or whatever. I got a lot of entries in and around here. So, I didn't get caught in this pullback. This was the floor for a long time. I knew that if Bitcoin was going to pull back to 107, that we were going to pull back further. Yeah, Bitcoin did pull back. These tokens get smashed, but look, it is what it is. You're earning on the side anyway. But as you can see, I mean, on the way back, even just to get back up to where we were in July is like a 6, 7x. So at one point, one of the pools was pulling in, I think it was 10 grand a week. So that compounds by 10 a week. The money can be crazy. But again, a little bit of luck is required here too. I.e., if, for example, we go into a bear market, then we're going to have to sit on this for a while. All right, so some of the results, I kind of mentioned some of them, but these are some of the results we've gotten in the last few weeks, just with some of the pools are in. These are volatile pools. So, okay, the initial deposits are quite high, 80K, there's 40K, there's a 20K pool, there's a 100K pool, right? So these are the types of ROI you can get. So, I mean, these are down massively. These were up much higher, and 10K a week for 80K, for an 80K pool. They're pulling back right now. But again, if Bitcoin decides to run to 135, 150, which we'll talk about in a second, these will all hopefully bounce back up. And if the underlying chain of the DEX you're on gets a bid, i.e. Avalanche has a few ETFs in the works as well, so does Solana, as well as a few trusts. If they all get approved and we see all that money flow in, not just from Ethereum, but also from Wall Street, then these DEXs get a hype. The meme coins run, the gaming coins run. Where are they going to do all those transactions? They're going to do it on the number one DEX on that chain, which is the highest trading volume, which in this case is Black Hole, which is the DEX we talked about earlier.
Is that some of the stuff that you're testing out with me?
Yeah.
Nice.
Yeah, exactly. In fact, that's your wallet up there. All right, cool.
Yeah, let's have a nice dinner then.
Cool. So that leads us on to the guy's product, which is something that's badly needed, because here's the challenge with these smaller DEXs that I just mentioned. There's no KYC. They're a bit of the Wild West, right? So in terms of institutions, that's not somewhere where they're going to come and play, And even for some of us who want to maybe park six or seven figures into them, you're not really going to do it in a DEX that doesn't have KYC and a proper team behind it that you know. So that's where the guys come in. This is one of their products. which I'm going to hopefully learn more about over the next day or so.
And then there's solstice.finance. So this is the staking company where you stake your Ethereum and you earn a yield. And then solstice.finance is our stable coin on Solana, where you also earn a yield. And you can go from our stable coin, which is the fifth largest stable coin on Solana currently at the moment, and then you can go to our other tokens and eventually have its own SLX token as well, which would be a tradable asset like you were discussing.
Yeah, exactly.
So brand new venture, 220 million TBL and
Yeah. Unbelievable, yeah. I mean, that's crazy. That's surpassed the other DEX already, and they've been going for six months. So there you go, unreal. But yeah, I mean, if any of you are trading and you have people in your communities, high net worth people, I get asked this a lot. Where can I park my money that's relatively safe, that I can earn a yield? You know, we all now know where we can do that, and that's the guy's product here. All right, so that's great. So should I be buying now? That's the question. Everyone asks me, should I be buying now? Is now a good time to buy? You know, whenever I make any sort of, not that I can give financial advice, but an educated guess on where we're at, I just use data, because as Dovey said, emotions are a huge part of trading. I would nearly say, the way my strategy, it's quite simple. I would say it's like 90%. I would say it's 90% psychology, 10% the strategy. My strategy is super simple. It has a 6 out of 6 win rate on the swings of Bitcoin on 3 to 5 month sort of time frame. But it's super simple. That's why it works. But should we be buying right now, or how do we know if we should be getting in or out of crypto right now? Well, there has to be a line in the sand at some point where we think that the market might turn around and we're going to go into a bear market. So how do we know if we're in a bear market? How do we know if we're in a bull market? There's a lot of data we can look at, but one very, very simple piece of data is the 50-week moving average for Bitcoin. So anytime we're above the 50-week moving average, it's pretty much held as support for a bull run. We've broken through it a few times, but once we get back above it, it holds as support. Every time we've lost the 50-week moving average for more than 2 weeks, i.e. price closes below the 50-week moving average for more than 2 weeks, every single time, it's marked the end of the bull run. So, where are we now? Well, we can kind of see there, can't we? We're right on that breaking point of, are we going to push up into the end of the year? Or are we not going to push up into the end of the year? And so what I'm looking for, because at some point we do have to keep it real and not just let the hopium and the hype pushes up. We have to be real about when we're going to close. So, if we break 2 weeks, as you can see over there, you see the red candle, one close, second close, that blue doji, that's 2 weeks. We went back up and retested, and that was the end. So when we break these moving averages, when we break these structure points, there's also a very, very strong weekly structure point at 101. So 101 is the price to remember. If at current market structure, if we lose 101, that's a big sign that we've lost major market structure and a huge moving average that has a very, very high win rate. What am I going to do if that happens? Well, for me personally, you never sell on the dip. We always get a pullback. In fact, if you look at the previous cycle, weekly candles, we had 1, 2, 3, 4, and even the 5th pullback. These are weeks, by the way. This would have been very, very tough on your psychology to have not dumped. But if you just waited for the 618 Fibonacci retracement or the 786, as Zoe was saying this morning, I use very similar strategy. You always wait for the pullback. They always come because there has to be liquidity that pulls back. So that's what I'd be looking for. I'd be looking for that pullback and have to cut my losses potentially on some positions. If you were to ask me at a guess, where would the next bear market be? I mean, 66% pullback, 70% pullback looks kind of fair, I think, in the range. So that would bring us down to maybe 58K in that range. So that's kind of where I'm kind of eyeing. But the biggest takeaway, I think, for me anyway, for you ideally should be, is time, is the timing. The crypto cycles are somewhat predictable. As they say, if it ain't broke, don't fix it. I'm not going to try and anticipate that we're going to push off into next year and keep going up into next year. Why would I do that when the data has always suggested that we top in Q4? If we move into December maybe and we're pushing up, then maybe we move into January. But realistically, you want to keep an eye on that 101K in the back of your mind, that 50-week moving average, and that should reflect any entries or decisions you're making on getting into pools. Because if you get into a pool and then we draw back, you're going to be stuck in that pool for quite some time in drawdown. So, but yeah, that's pretty much it. So any questions? Yo.
Like if we stake Ethereum on Solstice, that that thing. So we will get coins with that, the Solstice coin and Ethereum, both we will get.
Solstice Staking is an Ethereum staking platform. So
Okay.
you will put your Ethereum in there, you will get a yield, an annualized yield. It tends to fluctuate between 3 and 6%. It's structured and stable in the sense that that's the end. It does not pivot up and down. You do not get anything apart from Ethereum back. You're paid back in Ethereum. So you hold Ethereum, stays there, you get Ethereum. And then you can withdraw your Ethereum. Your Ethereum price goes up and down as per Steve's suggestion, but your Ethereum grows. So for me, I stake my Ethereum, and every single day I get paid Ethereum. So at the end of the year, I'll have more Ethereum than I started with. That's how I grow my Ethereum bag. Now, I hope that Ethereum goes up and goes from 4 to 5 and ultimately out to where I'm sort of targeting, which is sort of the 8 to 10k range, but years from now, not tomorrow, and I will have more Ethereum than I started with when I started this in 2021, right? With Solstice.finance, it's more of what Steve was talking about there. You deposit your stablecoin, you get USX, our stablecoin on Solana, which is backed, correct, by the other stablecoin USDT or USDC, so it's 1-to-1 in that sense, there is a backing. They're then backing onto other things, and as that, you get a yield as well. The yields change depending on the yields at that moment, and that again is annualized, 4, 5, 6%, and it's variable. Okay, it goes up and down, alright? And as we start developing the reward token and other tokens, you get those things as well. You play with flares and stuff like that, which all has inherent value. But you go to Solstice.finance and digest all of that before you start depositing.
Nice.
Not so much a question, but a comment. I think if you are interested in getting into crypto, you have to, like anything, think about kind of the country you're in when you do that, because like in the UK, for example, the only real on-ramps in GBP are regulated Kraken and Coinbase. You can do all of this and you can hold it and ride it for many, many years. The moment you go back from crypto to your bank account, you would be taxed 25% corporation tax. So, you know, ideally you want to figure out a way where when you come to realize that.
Yeah, when there's cash in this world.
Yeah, okay, you can do cash, but yeah, or you go somewhere like Dubai, right, where you can then take it out without.
Yes.
So 2 questions. One is where do you find these pools and how do you evaluate them quickly for someone new to the field? Number 2, how many have the KYC? You mentioned how Owen and Jason's new pool has KYC embedded into that, but any other pools that have that?
It's actually the opposite. It's provisional.
Permissionless.
Yeah.
Permissionless.
Okay.
Yeah, if you on board with big tickets, you know, high 7, 8 figures, then there will be some level of onboarding. But for the standard person, $5 to $100,000, it's permissionless. That decentralized app, you can just get in and out with your wallet. You connect it at any moment you go in, at any moment you go out. It's totally up to you.
Yeah, so that's basically the second question, I think. The first question, every major DEX on either layer 1s, they pretty much have their own DEXs and pools, so they're relatively straightforward to find. They're not that bad. It's just hard. It's hard to find a pool that you don't go out of range, because usually with pools, when you go into a pool, you're only going to earn your rewards and your fees between a specific range. So again, it's ideal in a consolidating market, like in a bear market. It's great because if you're trading, we're all traders, you can actually trade those pools, and the APY is insane. It can go up, like the pools I'm in are in 200% to 300%, but some of these pools can go up to, I mean, one of my members got I think it was 13,000%, and he was in it for a few hours. He made like 600-700 quid like that off 2 or 3 grand. But like he worked from home, so he was able to just like line up the chart, and like when the price is going sideways, as long as the price of the token that's in the pool stays within that range, you get a crazy high APY. But I mean, the easiest way to do is just to have the wide range, and then so you're kind of always in range. But even some of the wider ranges in SUI, for example, you can go out of range very easy. So you have to wait to come back into range to start earning towards the avalanche pools, because it's a new DEX. You stay within range all the time, and you're getting the native token as well because it's brand new. So the newer DEXs, the newer pools, they've added incentives to kind of get you in and readopt there, and that's where you get those crazy like 50x, 124x.
So obviously you're very knowledgeable and you understand the sort of the lead up. Similar to what Dobby was saying, there's a couple of flags that he goes, okay, I'm going to pull the trigger, and then it's management after that. To follow up on Halley's point, first we need to have the timing of our entry correct. So all of your your talk before actually leads up to making a decision.
Exactly.
Is that correlation always the case, or like Hattie's point was like, how do I see good pools? Should it be like, wait, don't bother looking at any of that unless you're happy with the timing first, because if the timing's good, then go to a pool, you have a chance. But if you're going down, let's say when you hit that range, that 50-week moving average, etc., then it could be a bad time to be in, where you're going to be holding for a while. Like I've held tokens for 2.5 years. I'm not worried about it, but I know that would stress other people out.
Yeah.
So is it first the timing and then go look for the pool, or what would you say?
Yeah, it's a good question. I guess for a volatile pool where you're pairing two volatile tokens, I would rather really wait for like the pullbacks and get good entries in. I mean, if you're in a bull market, you can wait for those swings that come every 3-5 months. But where we're at right now, it's because I mean, Bitcoin's up 600-700%. So getting in now is I guess is quite risky. So if you're going to get into volatile pools, I would be timing it with like proper trading. So getting in on like structural pullbacks, order blocks, supply zones, all those really important trading aspects. But if you're going to do a stable pool, then like the stuff you guys have and stuff doesn't really matter, because your initial is not going to move, you know. Yeah, it doesn't make a difference.
Yeah, and then you can play between the two as you start.
Yeah, but trading them can be very, very lucrative, especially when the markets, and crypto does this a lot in the bear market, where it just goes sideways. It's range bound. Like if you can sit in a range for a few days at a couple of thousand, 10, 20,000 APY, and you're getting that token, and again that compounds on the way up, you can make a lot of money. So yeah, it could be good. Yeah, any other questions? Everyone, nice. Thank you very much.